Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Lauren Goodwin joins us, Chief Market Strategist and Economist for New York Life. She braves the rain, comes into our New York studio, not mailing it in. Lauren, you got a research piece out. You're looking at the earnings from this past season, and you kind of say, hey, we got two Americas out there. What do you mean by that?
Well, it's really leveraging a Tom Keene sort of topic of the decade, but there is a very clear bifurcation in not just the consumer, but also in corporate America. And what I mean by that is if you have a little bit of investment money, a salaried job, you are doing, despite everything, just fine in this economy. You've been making money on your money, including your cash. Mm-hmm. Your salary's been keeping up with inflation. But for those that benefited in the early days of the pandemic from stimulus checks, from strong wage growth, the lower income consumer is really, really struggling with inflation, with the cost of capital. And that exact same thing is happening for companies. And so what it means is a couple of things. First, the biggest risk to the economy, and this is a little bit backwards, the biggest risk to the economy, I think, in the next year is a 20% pullback in the S&P 500. Because so much of this economy is driven by consumer spending, and so much of that wealth effect and confidence is sitting in the equity market.
And especially because if you go back, the down years for the S&P 500, back-to-back gains over the past 2 years, on pace for over 20%. We haven't seen that since the dot-com bubble. But also the only down years, 2022, we had the bear market, and then 2018, because there was that big sell-off of that final quarter, and that December was like the worst quarter since 2008. But other than that, it seems kind of tricky because we're so early into a bull run. The S&P 500's up like 70% since the low in October of 2022. That's not even like half the average of a typical bull run. So, what would really it take to see a down year and not just have like an average type of gain of around 9 or 10%?
Any number of things, and it's not really even our base case that we would see that drawdown. It's just a reflection that this economy, though incredibly robust, is starting to see its frays on the edges. And I think what that means is that if you have our base case, which is a pretty good year, we're expecting 5 to 7% on the equity market. Might not feel so great after the last couple of years that we had, but it's
I'm wondering too. 5 to 7%, is that more because of the broadening out, and so you'd see more like equal weight, small caps, other things taking part? So then the ones that have been the bigger weightings, like the Mag 7, it's like still there's strong gains. It's just you're seeing other parts of the index catching up. Is that the case for next year?
Yeah, I think it is part of the case for next year. Really, 5 to 7% is a function of economic growth right now, 3.5% real. That's wild. And I expect growth to slow back to trend. That's still a good economic outcome. It's just also still slowing growth from where we are today. And that's an environment where you do need to see more of the S&P 500 do the work. We're not enormously bullish on small caps or junkier stocks because of this bifurcation we're seeing in the economic environment. But what it means is that you probably have leadership ebb and flow a bit more over the next couple of years, whereas there's been a pretty clear dominant leadership from the Magnificent Seven as a result of AI.
Lauren, when we all woke up on Wednesday 2 weeks ago with a new president and now a decidedly Republican-led Congress. Did that change your outlook of the markets at all, or how you think about opportunities?
It's such an important question because I think over those same couple of weeks we've been sort of grappling with what are the Trump trades and now what are the Trump trade-offs? Which of those knee-jerk reactions are going to sit with us? And there are a couple that I think will, and those are the ones that are accentuated by some of the things we already knew. First of all, that growth has been stickier, inflation been stickier than even year after year economists like myself have expected. That when you add uncertainty around how much government spending we'll have, points to higher and more volatile interest rates. It means that even though credit quality is pretty strong, we need to stay short duration or focus on structured credit from my perspective. Another one that I expect to stick with us for the same combination of reasons is the strength in the US dollar.
Yeah.
When you see the US dollar dollar weaken, it's because ex-US growth is outperforming. And I just don't see any path to that in the next year. Doesn't mean we'll keep seeing gains in the dollar like we've seen in the past couple weeks consistently. It just means that we're likely to see that strength persist.
That's interesting because the DXY, if you look at this right now and you kind of draw it back to 2021 in that time frame, it's bumping up that resistance that we would have seen back about a year ago in 2023 and then going back to 2021. But is that kind of the biggest risk to potentially more robust gains in the equity market if you continue to see dollar strength?
I think the biggest risk to the equity market is rates, but they're not driven by 100% exactly the same things, but they have a lot of the same underlying contributors, namely that U.S. growth has been outperforming, U.S. inflation has been outperforming. That keeps rates sticky, unlikely to see the volume of Fed cuts that we'd expect, and that also, of course, keeps the dollar higher.
What did you take away from this earnings season that we're just kind of wrapping up here? What did it tell you?
Well, it told me that this sort of bifurcation of the consumer, bifurcation in quality that we're seeing is persisting. And though, as I do expect that we'll see more winners, not just from the AI trade as it broadens into energy and electrification, but also from the market in general as growth sort of stabilizes. But that demands a asset allocation shift over the course of the year, a new focus for investors really reflected in that data.
Something else I've been keeping a close eye on too is looking at S&P 500 earnings, but excluding energy, because that was the one that saw kind of the biggest markdowns coming into third quarter earnings season. And right now, I mean, the growth is still around 10, 11% when you're excluding that sector. Going into next year, even those revisions look like it's more commodity driven. How do you view energy in particular, and do you still think the other parts of the index will still hold up for next year when it comes to earnings growth?
I am relatively constructive on energy because I think that not only is it an important part of the administration and the sort of Trump trade dynamic just from a sentiment perspective, but increasingly it is the bottleneck for artificial intelligence. There's lots of really cool and interesting stats about how we as a global economy need to add Germany's size of electricity production over the next couple of years to keep up. Increasingly, chip makers have been able to keep up with Moore's law, but energy efficiency hasn't kept up. We need more energy per unit of compute now already than was the case a year ago. And so that constraint on one of the most important trends in the economy, I think, involves more capital intensive investment in support of that sector.
Tom Keene and I and some others, we were part of a AI panel that's hosted by Bloomberg Intelligence a couple of days ago here in New York. AI, I mean, how do you think about it? How important is that to you as a strategist and economist?
Well, it's important in two ways, at least two ways. One is the broader economic trajectory that we're on and the idea that this capital intensity of not just AI, but re-globalization, it does give us a medium-term constructive outlook. When you think about the private capital markets or a long-term view, you do see a lot to be constructive about in terms of just investment needs related to this trend. But the other thing that's important as a strategist is just the acknowledgement that though every move up in the Magnificent Seven has been justified by earnings, we are beginning to see their constraints. We are beginning to see more competition. I don't know that plays out in the first half of 2025, but the broadening of the trend into infrastructure and then eventually into corporate use cases will mean a broadening in S&P 500 earnings.
Lauren, thank you so much for joining us. Really appreciate it. Lauren Goodwin, she's the Chief Market Strategist and economist at New York Life.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's talk about the economics over in Europe. Some weaker PMIs came out today. I think surprising some people as to, kind of going back into a contraction across there. Dr. Vania Stavrakeva, professor of economics at the London Business School, joins us. Professor, talk to us about the economic activity we're seeing across Europe these days. I mean, the central banks are easing, but still some challenges out there. What are you seeing?
So thank you so much for having me. Unfortunately, we don't have many good news in Europe, both the Eurozone and the UK. And we have seen significant divergence also reflected in the stock market performance, as you're of course aware. So since the Trump elections, the Euro Stoxx 50 has decreased substantially while the S&P, etc., has increased. What's interesting is if you look at historical data, and not go back that much in history, but post the global financial crisis, you find a very high correlation between aggregate stock market price growth returns across the US and the Eurozone, for example. So in the data, the correlation is around 86%. However, we see sometimes divergence. So nowadays, we definitely have divergence since the election. And another period during which we had significant divergence was during the post-2016 Trump elections. So if you look particularly during the period from June 2016 until June 2019, you find that the correlation between the US and the Eurozone stock market drops to 70%, which is a drop of 16%. Now, what does this mean? Well, actually, I have recent work which allows me to decompose the movements of idiosyncratic stock prices, but also aggregate stock market indices into easy to interpret components. So what do we do in a paper titled Elephants in Equity Markets? So we take, let's say, individual stock price growth rate or the aggregate stock market, and we decompose that growth rate into the subcomponents of the growth rate of holdings. So what are those subcomponents? Well, the stock price could be moving because the portfolio managers are rebalancing their weights, the weights that they place on this stock or stock market in their portfolio. It could be moving because of what we call wealth effect. So let's say the net of fee returns of the fund are good. So it's like an amplification effect. They could be moving because of final inflows or outflows into the funds, and also exchange rate valuation effects, which capture, for example, that US dollar investors hold global stocks, for example, Euro stocks.
Also, we wanted to point out, because Paul was talking about this earlier, looking at the euro in particular falling to its lowest level since 2022. Walk us through kind of the dynamics when you're thinking about Germany and France, because that's obviously the Eurozone's two largest economies. And we were thinking about those increasing bets that the ECB is going to have to boost the economy's region by potentially a half-point cut. Whereas over here, if you're thinking about the Federal Reserve, that's getting dialed back to potentially maybe even a pause potentially in December. Walk us through the dynamics when you're thinking about what's happening in the Eurozone versus what's happening over here in the US. And then, of course, very different dynamics if you're thinking about the Bank of Japan.
Yeah, so in general, using this decomposition, you can trace it to portfolio weight changes. So it's the same nowadays. So why are the investors rebalancing their portfolios differently with respect to Eurozone countries than the US, which is kind of aligns with your question, why now we see that we're pricing differently, let's say French and German stocks relative to the US stocks. So what are the news potentially driving the divergence at the moment? So what we see happening is definitely there is a lot of concern, of course, around tariffs and differential regulation across industries in the US and Europe. Granted that the Eurozone is a much more open economy, tariffs are going to hurt much more the Eurozone than the US. So that's one of the factors. Another factor, which I believe is going to be first order importance, maybe not so much priced in at the moment, but it's going to be priced in soon enough and definitely in the medium run, is the different fiscal sustainability path across the Eurozone and the US. So we already seeing in the UK, we saw the latest budget, which implied significant increase in terms of taxes for essentially capital, essentially firms. So this is definitely going to slow down growth. I do believe that the Eurozone is not different in the UK. Both the UK and the Eurozone have unsustainable welfare states given the current tax system. What do I mean by this? We are taxing labor as much as possible, meaning probably we have reached the maximum amount of taxation we can impose on middle income and higher income earners. So we need to start taxing capital. We are seeing that in the form of labor. This is not so easy to do. If you tax capital, also you decrease real-term growth. What do you see in the US? It's exactly the opposite, right? We got Trump, people anticipate lower taxes on firms, but moreover, the fact that he appointed Elon Musk to a newly formed essentially agency that is the only goal of which is to decrease the size of the government, we would expect that the goal of the Trump administration is to decrease the amount of taxes you need to essentially get in the future in order to finance the government. This is very different from what's happening in Europe. So this is going to definitely hinder growth in Europe overall. How do we fund the welfare states? What do we tax? Who do we tax? Higher taxes definitely are going to translate with lower growth and, of course, worse performance in the stock markets.
Is there any political appetite, Professor, to lower some of the expenditures across Europe? You talk about the welfare state. Is there any political, expectation that could be reduced over time?
That is a very good question. Unfortunately, we're in an equilibrium where fortunately or unfortunately, when you have big welfare states, you have usually a large fraction of the voting population benefiting from these big welfare states, right? So the statistics shows that in the UK, more than 50% of the population on net receives more benefits than pay in the form of taxes. If you have a big chunk of the population benefiting from the welfare state, it's highly unlikely for them to vote a party in power that is going to promote cutting the welfare state. So I do believe that the only way we can reduce, I'm not saying that's optimal or not, but this is from the perspective of growth and performance of European stock market. The only way to decrease the welfare state in Europe is over time to reach the limit of fiscal sustainability, meaning you have very high level of debt to GDP, you have reached the max level of taxation on labor income, right? You are finding that increasing taxes is actually not increasing revenue. So once we reach that point, essentially any party in power is not going to have a choice and they'll have to do something about essentially the welfare state. But that is very costly. It's going to take time to get there, and it might mean at least a decade or even more of low growth in Europe.
Okay. Professor, thank you so much. We appreciate that. As always, Dr. Vania Stavrakeva. She is a professor of economics at the London Business School.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
What is going on with Bitcoin approaching 100,000? This might be the Matt who also forgot his token number and is just asking for a friend here. But let's go to Mike McGlone, Senior Macro Strategist for Bloomberg Intelligence. Mike, you're the only one that's explained to me what's going on here with this Bitcoin. So I guess it's just more buyers and sellers here?
Definitely now, Paul, more buyers. You're looking at this month alone, ETF flows in ETFs are approaching $6 billion. That's the biggest month ever. Total ETFs tracking Bitcoin now around 120 billion. To put that in context, that's about half of what you see the total amount tracking gold, which is about 220 billion. So it's catching up really fast. A year ago at this time, total ETFs tracking Bitcoin was around 10 billion. So massive buying for good reason. We have a crypto president, remember, knows out like a convert. When he was president, he thought cryptos were a scam. And now he's realizing, oh boy, this basic space tracks the dollar. But Paul, we've had some major double dog dare potential peak signs lately, and I'm really concerned about it. I'd like to tell you about it.
Well, talk more about that, because it looks like it's up about 40% just so far this month. So how much more gas is left in the tank here, and where are you looking at for like resistance and support levels?
Well, there you go, Jess. The key level everybody's looking at, round number, $100,000. I first mentioned it almost, I think it was 4 years ago.
Yep.
Kind of fell off the horse for a little while. But, just the diminishing supply, increasing demand and adoption. But there's a key thing So 100,000, very good resistance. It's traded it in futures, but that's a little different. The key thing I'm watching is Bitcoin versus gold. Right now, that ratio, it takes basically about 36 ounces of gold for one Bitcoin. The all-time high is still in place. That was 37 in 2021. But there's one key headline that really struck me yesterday I was really concerned about. It's the lessons you learn in a trading pits, and it's never mess with the market gods, particularly if you have profits. You kind of should be modest about this. Here's a headline in Bloomberg Terminal: Warren Buffett destroying $3 billion a month of Berkshire Capital by not investing in Bitcoin, says Micro Strategist Michael Saylor. I saw that, and I remember Michael Saylor. He was one of the persons who really kicked over my bullishness in 2020. That was in the back of the Attorney General in New York coming down in Tether in 2019. It all proved how bullish Bitcoin is. But now when you double dog dare markets like that, I think you got to be careful.
So I don't know, Mike, maybe I'm wrong on this, but I kind of think of this as a commodity. How can you put valuations on commodities, or do you? I know in the past you've kind of talked about it in relation to other commodities, in this case, gold.
Yeah, definitely. So I look at versus gold. So one thing I'm about to point out today, Bitcoin's actually dropping a little bit down at 90, just below 9,800, and gold's up over 1%. Part of that is the re-escalation of global tensions, most notably in Ukraine. But you don't. It's diminishing supply, increasing demand and adoption. We get that. That's why I pointed out right away. Massive inflows in ETFs. But one thing about this space, Paul, it's the most widely traded speculative digital asset on the planet ever. 24/7. Come Saturday me Sunday. Sometimes I can't stop watching it because it gives you indication what's going on. So everybody trades it. There's massive arb going on. A lot of people got a little bit too short MicroStrategy and got stopped out. Now we have some bigger people doing that, so that got too expensive. But number one thing, I think it's technicals and animal spirits right now.
Talk to us about Dr. Copper, because we know how closely it ties into the economy, not just our economy, but the global economy as well. What are you seeing there?
Well, Jess, I appreciate you going there, because to me, that's the number one commodity that has to go up to prove we don't have deflationary dominoes kicking over in the whole world. So Dr. Copper is broken below key support around $9,000 a ton. In terms of dollars, it's pushing in that key support around $4 a pound. It made a new high this year around $5.20, but it was on the back of massive speculative excesses in futures. Futures are just a lot of buyers who just got way overweight long. And the key way I like to point out with copper is on the month now, copper's down about 5%, and the Hang Seng Index is down about 5%. You see the connection there. It's all about China. And I look at that 10-year note yield in China, 2.08 on a CGB versus the U.S. It's 4.4%. That's a significant sign of deflation, lack of demand pull forces in China, complete dependence on stimulus. And we've seen this before in Japan. Japan's GDP at $4 trillion is the same it was 30 years ago. China's going that way. That's bad for copper. And the key thing I like to point about copper is if it breaks down, it adds legitimacy to declining crude oil, declining iron ore, declining grains, and it means the commodity complex is clearly showing global deflationary, recessionary trends. And gold's the only one that's really still going up.
What's the call in the energy front for you, Mike, these days?
It will start with what matters to Americans. $3 a gallon as the average price of gasoline. By this time next year, Paul, if you want someone to blame, I think it's going to be $2. Average value price of diesel in this country is just about $3.50. I think next year is going to be $2.50. It's not profound to say that because the last 20 years we've got to those levels. And the big significance is we are a net massive, increasing everyday exporter of liquid fuels, crude oil, unleaded gas, diesel, maybe less, and we have diminishing. We have demand for diesel, and U.S. is declining. It's declining in China, in Europe, and India, and we have increasing supply. So if we just get a little bit of a backup in, say, the stock market, it pushes those prices down. So those are, I had in my headline recently, those are potentially Trump deflationary forces. And we do have this new leadership that's more drill at will, bring on the supply.
What about natural gas?
Yes, so this is peak season for natural gas. It's usually right before you get to January. $3 natural gas is near the peak. I think $4 is pretty high. The cost of production in this country is $2. That's been kind of the median mode. I think it gets back there once we get through January, and we have the normal trend in global warming happens in winter too. So basically right now you have to price in a bit of risk of a colder than normal winter, but what's been the trend? Warmer than normal winters, particularly in Europe. So that's the key thing. Is the bottom line for natural gas is the world's becoming increasingly dependent on LNG exports from the U.S., but still only about 20% of our production, and we still have a pretty good excessive amount of liquid fuels, natural gas, crude oil, ethanol, biofuels in this country, dependent on exports. And if we ramp up a trade war, that means we're going to have kind of supply bottlenecked in the U.S., which means lower prices.
Mike McGlone, thanks so much. We appreciate it. As always, Mike McGlone, Senior Macro Strategist for Bloomberg Intelligence.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Your daily look at the front pages from around the world. Lisa, Mateo, what do you have for us from the newspapers today?
All right, so we've been talking a lot about retail earnings, right? You've heard Walmart, Target, like Rust, like all these different companies. But now with the election behind, so this is interesting from the Washington Post. They say that with the election behind it, consumers are ready to spend because they say normally what happens is that before election day, they're a bit hesitant. So they hold off. But they say now that that's over, it's going to open up. More retailers, more shoppers are ready to do different things, but they're shopping differently. Okay, one thing they're going to do, they're going to look for deals. Okay. They're going to be selective on the splurges, and they're going to hit up discount and off-price realtors. Like Walmart, Gap, they said they're drawing in like those six-figure retailers, consumers.
And that's new, it sounds like.
Yes.
It sounds like I haven't heard them call that out before, And I've heard it from a couple of them.
Correct.
From Walmart.
Yeah, and Target's saying like a lot of their consumers are shifting to like the cheaper brands. So you saw that Ross stores. I mean, they reported well too. So that's like the discount retailer.
That's right. Lisa and I were talking about earlier. We don't do the Lululemon. We find other things at Gap.
Well, I do the store brands at the supermarket more than I ever have.
True, I do that too.
But some things I'll go with the brand. You know,
right.
Some things that are important.
I'm
But some things
selective.
I'm like, you know.
But that's what it is. So they're
and
saying
it's materially
yes,
cheaper.
yes,
Okay.
most
Interesting.
definitely. So we're spending, but we're just spending differently.
I tell you, I don't think my spending patterns have changed, but since the election, it just feels like a weight is lifted. You can just move forward, look
what it
forward,
is.
if
Right.
nothing else. It seems better just
pressure's
because
off.
the whole thing's behind you now.
Right,
we can
right.
to look forward.
And now you know what to look forward to.
Exactly. What else we got?
Okay, so this one is right up your alley. Paramount executives. It turns out they're getting a nice bonus after the deal with Skydance closes. So this is according to a
Surprise.
filing. Yeah, they're promising to pay its heads of government relations, human resources, a $1 million retention bonus that's tied to the merger. But I guess this is the thing, like retention bonuses are common. I mean, when they're doing major changes.
Having worked on Wall Street my whole career, and I've been through a bunch of mergers, when company A is buying company B, what you're really buying are the people. I mean, when you go for an investment, you're buying the people. So you want the people to stay. So one of the ways you get them to stay is you pay them a retention bonus. Hey, here's X amount of dollars to be paid over the next 3 years. If you stay, you'll get this money. That kind of thing. We did not do that when Credit Suisse bought Donaldson, Lufkin, and Genret, and literally the next day after the close, everybody walked out the door. It was a disaster.
Oh, so that's why they do that. Okay,
exactly.
so now it makes sense.
So they do work. They work. I don't know about for the entertainment business, but this Paramount stock, it's at $9. It's still down 25% year to date. That's a tough story there.
Yeah, and the reason why people are upset is because they just announced plans to cut 2,000 jobs.
Yes.
So at the same time that this comes out.
Yep.
So ESPN is going into the late night talk show scene. Former Philadelphia Eagles offensive lineman Jason Kelsey is going to be the host of it. Okay, so he announced it on Jimmy Kimmel Live. It's going to be called They Call It Late Night with Jason Kelsey. Original. There
Very
you go.
good, yeah.
So they're going to tape on 5 straight Friday nights starting January 3rd. And that actually falls in line with the NFL's regular season, the playoffs. So you kind of see the tie-in there. But I mean, he's a personality.
Yeah.
I mean, I don't know.
No, it's great.
No, he can
Post-career, he's doing well.
And it's going to tape in front of a live audience in Philadelphia, which is, there you go, Philadelphia Eagles. But they have this Philadelphia-based band, Snack Time. They're going to have the music. So it's a limited run, but he's doing it. He's going to the late night talk show.
I mean, the late night business, that's always been a pretty profitable business for these companies because they get great guests, the ratings are okay, and advertisers kind of like that time period. So I don't know. It's always been pretty good, but I mean, it's just and he's got certainly name recognition.
He
these
does,
days,
and he has this. I mean, it's in the first year, but he has a multi-year agreement with ESPN. So
but this is
kinda
the
like
brother
part
of the
Yes,
Swift
right.
Kelsey. Okay.
Correct. Yeah, I knew that was going to come up, but correct.
Okay, I can't keep track, but he's
The
the guy
brother
that-
of Travis
Yes,
Kelce.
Okay,
he's the
very
one who's
good.
retired. Yes.
All right, very good.
Yes,
From
he's
the
no
Eagles.
longer playing from the Eagles. Yes. All right, and this weekend, yes, the big Wicked movie coming out. So this one in the Wall Street Journal say fans are going crazy. Like they're renting out theaters. One woman, she has like 100 guests coming, but they post rules. There's certain rules, and you have to remember movie theater etiquette. Okay, so costumes are a must. Loud chewing is unacceptable. Bathroom breaks are no. You can't leave your seat, and no singing along.
Singing.
And it's a singing movie, I know. But there's other movie theaters that are doing something different. Like they have movie theater parties for Wicked, where you can sing. They give out goodies, and then wait until Christmas, guys, because there are sing-along screenings of Wicked coming out.
Here we go.
A lot more than 1,000 theaters are going to be doing this. So then there you're allowed to sing.
So Paul, are you gonna be?
I do not have my tickets yet for Wicked, but you do, Lisa, right?
I so my daughter has the Wicked, went with her friends, and then my husband and I are doing the Gladiator.
Okay.
And my son are doing the
So
Gladiator.
this has got some, I mean, this Wicked thing, and even Gladiator, but I mean, it got some real serious buzz, doesn't it?
Yes. No, it definitely does. And because it's two different audiences, so they're saying this is what, it's like the Barbenheimer. This
Oh, that's what I was about to bring up. It's like
Yeah.
that again.
Yeah,
And you got
so it's all
Denzel
over.
in Gladiator.
Oh, my
I mean, what a
favorite.
legend.
Yes.
And
Yes.
Thanksgiving's traditionally
And
has
it's
been
a
a really good
holiday
time.
coming up on the
holiday
holidays.
weekend.
So instead of traveling, let's go to the movies, guys.
That's good. I mean, I tell you, the movie, the Hollywood business, the movie business,
Yes.
could use a shot of good news and good economics.
And Bloomberg Intelligence, they're saying that the box office is expected to take in $230 million with both of those movies. So that's a pretty, I mean, it's no Barbenheimer, but it's still
that's
a good,
solid. They'll take
solid numbers that
Absolutely.
they need.
All right, that's the newspapers with Lisa Mateo. Thank you so much. We appreciate that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.